Podcast is now starting. All attendees are in listen-only mode.
All right. Hey, good morning, everyone. I'm Doug Mitchell with Ogletree Financial, and I want to thank you guys for being on our webinar today. We've got Tom Martin. Tom Martin is the Director of Life Marketing and Analytics at North American Company. He's done hundreds of these webinars, and we're lucky enough to have him doing one specifically for us today. He's got over 25 years of experience in the life insurance industry. He's been an agent, and he's been in the home office in underwriting, customer service, and marketing. He has his CLU, his CHFC, his AALU, and he also has many other designations we won't list here. But Tom is actively involved in product design and marketing at North American, and he has a great deal of insight and industry-leading knowledge in Index Universal Life. He's passionate about life insurance and supporting sales to ensure mutual growth and success. Tom's presentation today is on demystifying IUL. He's going to be covering some of the following topics that you all have questions on. How companies use bond and call options to cover index credits, why there needs to be a flexible element such as caps, participation rates, spread rates, and etc., how variable loans work, and then also a burning question here, why annuities and life insurance have significantly different caps. So, Tom, we appreciate you being on our webinar today. As you know, this is a series. We've got actually 6 parts to this webinar. So we're very anxious to hear what you've got to share with us on demystifying IUL.
All right. Well, thank you very much, Doug. I appreciate that. Yeah, there's a lot of interesting things, and I know that even though you might understand IUL, hopefully there's something more that you might gain from this our next 30 minutes or so here today. What we're going to cover today, as Doug mentioned, we're going to talk a little bit about index crediting, how companies afford to do this, talk a little bit about cap or participation or spread rates, talk about how variable or participating loans might work, and then wrap it up with, as Doug mentioned, annuities versus life insurance. First, providing index credits. Life insurance, Index Universal Life is really not substantially different than fixed UL. And I know sometimes we get hung up thinking that it's really complicated or really involved. It's really not. Life insurance companies, we still invest in bonds. It still provides an interest rate. The only real difference is that instead of a fixed interest rate, we provide an indexed rate related to the movement of an underlying index. So sometimes people kind of wonder, well, how can a life insurance company afford to do this? How can life insurance companies afford to provide index credits of 6, 7, 8, 10, 12% or whatever? Well, we do this essentially with bonds and call options. That's how. There's not a lot of interesting things more than that. Life insurance companies do not go out and invest directly in the market. In general, that's not the way IUL is designed or funded. We don't want to make a big profit when the market goes up. We don't want to take a big loss when the market goes down. Life insurance companies want this to be revenue neutral to the company. And they're really good at bonds, and so we continue to invest in bonds. Well, if bonds are only paying 4 or 5%, how can we credit, in index interest of, 7, 8, 10%? Well, we use call options. So let's talk a little bit about call options. A call option is kind of like a bet on the market, so to speak. When the index goes up, the call option pays off, and we get money from that option, and we can use that to pay out the index credits. When the index goes down, the call option pays nothing, and then we credit nothing. So you can kind of already see a little bit how this works. We take the interest that we earn from our bonds, and we go out and we buy an option. And when the option goes up, we have the money to pay out the index credits. When the index goes down, then the option pays us nothing, and so we pay nothing. So that's I'm going to go through an example of that in a little bit here. But the other thing to think about is, well, some people say, gosh, it seems like if you're only paying out, if you've got a cap of 10 or 11 or 12%, if you've got a cap on there and the index goes up 20%, is the company making a whole lot of extra money then? What's going on? The company, if we're capping it at 10 or something and the index earns 20, then the company's making all this money. No, again, the design here is that we're trying to be revenue neutral. So, and I said, at the start, some people might, get a little bit more than this and some others. So sometimes I'm going to be general and sometimes I'm going to be specific. So here's the specific part. For people who understand call options, there's not a cap on a call option. Even though we have a cap on our IUL, there's not a cap on a call option. A call option has a strike point or a point where it starts to pay off. On IUL, we get calls that pay off at 0. But then if the underlying index earns 15 or 20 or 25%, the call option is still paying off. Well, that's not what we're trying to do. We're trying to get a call option that pays off, that matches our obligations to the client as closely as possible. And we have a cap on many of our products. So if the cap is at, for example, 10 or 11 or 12%, we don't need a call option that pays off up to 20. So what we do is we buy a call option that starts at 0 and pays off indefinitely all the way up. And then in order to essentially get one that is a limited range call option, then we sell a call option that starts at or has a strike point at our cap rate. So let's say that we had a cap at 10. We would buy an option that starts at 0, and we would sell an option that starts at 10. Basically giving an end result of a call option that perfectly meets our obligation. It's typically a 1-year point out that meets our obligation almost exactly of what we are owing to our customers. So then this becomes very revenue neutral to the company. That's the whole idea here, is focusing on revenue neutral. Now there is a variation. Now, not what I'm talking about here was basically I think that would be in static hedging, where basically this is what we want to do. Dynamic hedging would be another way to do it. So there are two ways that you could do this. One would be entirely based on options, and another way would be doing a little bit of investments in the market and doing and trying to save some money and some of your costs by doing a little bit of your own, so to speak, hedging. Instead of using entirely bond options, you might do a little bit of your own market hedging as well as a company. So companies can do this in multiple ways. It could be either static or dynamic hedging, but for the purposes of discussions with the client and the easiest way to explain it, this is really all done with call options and with a focus on the company does not lose money when the market goes down. We don't make money when the market goes down. We don't lose money when the market gets 20. We don't make money when the market gets 20. It's all designed to be revenue neutral. So here's what happens. The client pays the premium. We take those monies and put them in our bond portfolio, which we do on all of our other UL and IUL products anyway. And we take the interest on those bonds and we go out and buy options. And then the index performance determines whether or not the options pay out. And if the options pay out, then we get the money that is available to credit interest to the policy. So this is how it works. So now we have to think about, well, okay, what are some of the elements that could change here? What are some of the things that are variable and may have some things that could go different ways? And those are really about cap and participation rates. Because when we're looking at our caps or participation rates, or you could also include, I guess, spread rates on here, there are a couple factors that we need to consider when we're looking at indexed universal life. And that is, how much do we have to spend on options and how much do the options cost? Those are two factors that change in time. Our option budget, so to speak, is typically, what are we getting from our invested bonds? How much are we getting from bonds? And that, in large part, will determine how much the caps cost. But the other part is, well, how about the prices, the option prices? We don't set those. That's a free market item. So we have to identify two things. How much do we have to work with? What kind of returns are we getting on our bonds? And secondly, how much do the underlying options cost? And that's a free market item. So these things may go in the same direction, they may go in opposite directions, they may counteract each other, but because there are these two elements that can change, we need to have something in the design of a product that can accommodate for that. So that means we have to have either something that can move in every index life policy. It's either the cap rate or the participation rate or a spread rate or something like that. One of those elements has to be able to change because we don't know for certain what the bond returns will be over the life of the product, nor do we know what the option prices will be. That's why we have a cap or a par or a spread rate, one item always that can be adjustable, and it's because we don't know what these factors will be. Then we get into the idea of variable interest rate loans. And when we're talking about variable loans, I think this is interesting. And you could also use participating loans to be a very similar aspect. So when I look at participating loans, we have to think about how does this work? How can you essentially take money out of the policy and still get interest credits? That's really interesting to many people. That doesn't make sense. And how you can perhaps get even positive arbitrage, how you can make money on money that, as far as the client's concerned, they took out of the policy. So we have to look at and see kind of how this works. First, we want to look at how borrowed funds can participate and how the variable rate loans work. Whoops, sorry about that. I just jumped ahead. How can the borrowed funds still participate? Well, let's think about that for a moment. If a client has $100,000 in a policy and they want to borrow $20,000 out, there's only $80,000 as far as they're concerned. And again, this is not a withdrawal. This is a borrowing as a participating or variable loan. As far as they're concerned, they took $20,000 out. There should only be 80 left. Well, you didn't take that money out. That's not a withdrawal. You're borrowing the money. So all the money is still in the account value. It's just that the account value is being used as collateral for an outstanding loan. So there's still $100,000 in the account value, but there's also a $20,000 loan against the policy. So when you look at the net effect, yes, $100,000 minus a $20,000 loan is a net surrender value of $80,000, but the whole 100 is still in the policy. So how can we still have indexed universal life credits on that though? Because that we're not really, are we still investing those money in bonds? No, we're not. But we're getting interest on those loans that is comparable to the rate that we would get on bonds. So if you have a company that has variable loans, they typically set the variable loan rate at a rate which is comparable to the Moody's corporate bond yield. The same type of rate that we would get if we went out and bought new bonds today with that money. That's why we set a variable loan rate that might fluctuate a little bit with the bond rate. And so today a variable loan rate might be 4%, a competitive rate because bond rates are low. Or company may have a fixed participating loan, in which case the loan rate is usually higher, 5, 5.5, 6%, because then they need to hedge a little bit for the idea that loan rates, bond rates might go up in the future, so we need to be more conservative and have a higher rate of interest than might be affordable, at the moment. But either one, they're essentially the same. If the company says, we don't care where the interest comes from for our budget. When we're looking at buying index options, we don't care if that money comes from our bond portfolio or if it comes in part from the client's loan interest. Either one, it's the same thing to us. So that's why an indexed universal life policy can have a participating or variable loan that participates in the index, is because it still provides the company a source of funds, whether it is the bond returns or the loan interest charges. It still provides a similar source of funds for us to go out and buy options. And that's why we can afford to do this. The reason I like variable loans is because, again, that gets the idea that if you're in a low interest rate environment, the bond rates may allow you to have a lower rate potentially than a fixed participating rate loan can be. So I like the idea of a variable rate loan as long as and this is important in my opinion, as long as they're capped. You have to really think twice about the excitement of a variable loan if there's no cap on the loan rate. So it's nice to have a variable loan rate. Variable loan rates are nice as long as there's a cap on how much they can go up. So I think that's an important element to think about, is whether or not the variable loan rate is capped. Fixed participating rate loans are fine too. In a low rate environment, they're not as exciting, but in a higher interest rate environment, they could be very strong. But either way, a cap is an important part of it, so that they don't run away from you too much. If we get back into bond rates in the 7, 8, 9% range, you probably would not be real thrilled to have a loan rate that's being charged 7, 8, or 9%. And then the last element here that I wanted to touch on is the idea of indexed universal life versus indexed annuities. So what's the real difference here? What's going on here? And I think if we've, a number of us have been in the industry for a little while and been seeing and looking at indexed annuities, and you recognize that, wow, they are really different cap rates, and indexed annuities are designed different with a lot of different little techniques or little systems that they can use to try to make them appealing, because it's so hard right now in the current interest rate environment to get a compelling cap rate or participation rate on indexed annuities, and why are life policies so much higher? And then I think the follow-up question that sometimes goes with that, people say, well, are life cap rates and par rates going to drop all the way down to the annuity rates? Is this just a precursor of what's to come? Should we expect those rates to go all the way down to what the annuity rates are today? So I think that's interesting, and there's a couple things to consider here. First is the bond portfolio and the perspective in that. Let's think a little bit about the bond portfolio. Life insurance products are designed for long duration. They're designed typically for 20, 30 years, lifetime type of thing. So when life insurance companies are buying bonds to support their products, their life products, they're buying bonds that are long duration, 20, 30-year bonds, and generally bonds of longer duration as opposed to like 5 and 10-year bonds. Generally, those pay out a little bit better rate. They're also, because they're looking at a long duration type of thing, life insurance policies are typically priced on a portfolio rate, because we're looking at all sorts of products, and monies may be coming in on a regular basis, and this product may be funded for 20, 25, 30 years. So we look at our entire portfolio of bond rates, and we use our entire portfolio typically in order to price indexed life products. Annuities, on the other hand, are very transactional. They're designed to be a little bit shorter term, and they're very price sensitive. So annuities, we may see things that they may invest in shorter duration bonds, and they need to look at bonds in more of a new money rate, because annuities are that transactional lump sum asset transfer type of thing. And so typically you're going to look at annuity products that are designed with a new money design. So part of the difference between life and annuities is that idea of a portfolio rate and a new money rate, and part of it is the difference in bonds. And ultimately, this is all going back to the second bullet here, which is the option budget. How much money do they have to spend on options? That's ultimately what is driving the difference between annuity caps and life caps. So part of it is the new money rates versus the portfolio rates and the bond durations, as I mentioned. But a second part that's driving the option budget is, how do companies make money? And company needs to have the lights, pay the agents, pay the customer service teams, and underwriting and issue, and all sorts of other things. So how do the companies get their revenue? On a life insurance product, there are many ways that a company can garner revenue on a product. And that could be, additional policy fees and charges and loads and all sorts of different things, percent of account value, all sorts of different ways that a life insurance company can get profits. Annuity companies generally can only make profits in one way, a spread. a spread between what they're earning on their bonds versus what they're paying out on their bonds. That's how annuities can typically make money. Life insurance companies have a lot more things available to them to get revenue. So if we think about combining those two items together, and I'm just going to throw out numbers. These are not, currently precise or anything like that, but they're just generalizations to get the point across. Let's suppose that a life insurance company's portfolio rate is 5.5%. That's kind of the rate they're getting on all their bonds. Now they might take a little bit of a spread too, but because they can make monies on other things, policy charges and other things, they don't need to take a large spread. Maybe they'll take a half a point spread on their returns between the bond returns they get and what they can allocate toward their option budget. So a life insurance company might have 5% of the client's premium available in the terms of interest returns to buy options. Now let's turn around and look at what an annuity company might have on an annuity. First of all, it's of course new money rather than portfolio returns. So we have to look at the new money rate. That might be more like 4.25% or 4% because they're buying a little shorter bonds. So instead of having 5.5% to start with, an annuity might have 4% to start with. Then you have to look at an annuity company has to make their money on spreads. So maybe they take 1.5% instead of 0.5% or 2% or some other number. Maybe it's 1.5%. I'm just kind of making up numbers here. They're not precise. But if we take 4% minus 1.5%, now they only have 2.5% left on an option budget to buy caps and pars and spreads and other things. So an annuity might have 2.5%. A life insurance company might have 5%. You can see the reason why there may be a significant difference in cap and par rates between life and annuity. But what happens when what happens if the portfolio rate drops? What happens if our portfolio rate drops all the way down to the new money rate? Well, then life insurance company cap and par rates certainly could go down, and there's been that pressure for a number of years. And we've seen that life insurance companies are struggling on their IUL products to maintain cap and par rates because the portfolio rate continues to drop. As we buy new bonds at 4%, that portfolio rate continues to drop. So yes, there is some of that pressure there. But it might not drop all the way down to the annuity new money rate because, again, bond portfolios might be a little bit longer duration. You might get a little bit better return there. But even if it did drop down to a very similar rate, remember, we still have that difference between how companies make money. So I think in a low interest rate environment or in a stable interest rate environment, I think there's always that possibility that life insurance companies can have a higher cap or par rate than annuities. Not to say that that is always going to be the case, because if annuity companies are using new money rates, they're going to be very quick to respond. Portfolio rates are very slow to move. Think of the portfolio rate as a big ocean liner. It takes a long time to turn these things around. Even if the bond rate went up to 7% tomorrow, life insurance companies are going to take a long time to start moving cap and par rates because their option budgets take a long time to move when you got a whole portfolio. Annuity companies are very agile. They're very quick and can move almost as fast as the bond rates themselves. So if the bond rates jump to 7% tomorrow, annuity caps and pars would immediately jump and perhaps even be higher than life products. So we can't say that annuities will always be lower than life. That's not the case. But in today's environment, I wanted to say why that annuities have been lower and have been lower for a number of years in life. It's largely those two aspects: the bond portfolio perspective and the option budget. So in this little half hour, a little less, we talked about a few things. Hopefully this was of interest and might have given some people some insight. How companies do index crediting. It's basically, we still invest in bonds and we use options, and it's all designed to be revenue neutral. We have cap and participation rates, and the reason we need to have a cap or participation or spread rate, I should add, is because we don't know the prices and the returns that we'll get. So we have to have a factor that can change to accommodate for that. We talked a little bit about variable or participating loans and how they work, and how the company can afford to do this. And really, it's an amazing aspect of indexed universal life that can make for a very compelling product and illustration. And we talked a little bit about the difference between annuities and life insurance, and understanding that idea of how the portfolios that the companies invest in and the new money versus portfolio rates, and a little bit about how companies need to get their returns, how that can change things around a little bit as well. So, I hope this was helpful to you. I know this was just kind of opening the door perhaps for more questions, but I tell you what, that's why you've got, Ogletree and Doug there. They can certainly help answer more questions for you, or give you direction on understanding this even better. But as always, this is just something that is helpful to know, a little bit of background around, and helpful to have a resource available to you. And I tell you what, Ogletree is impressive, and Doug can be your resource. So I would certainly throw additional questions that you have back at them. With that, I think, Doug, you want to wrap us up, or see if there's anything I missed?
Absolutely, Tom. We appreciate that. I think that was very informative. We get these questions all the time from agents, and we just don't explain them as well as you do. So it's going to be good to have this as a backup when we do get those questions. But guys, look, this is a 6-part series. We're going to have a lot more good information, just like what Tom brought us today. So stay tuned. You're going to get the reminders to jump on the next 4 webinars. If you have questions, call us here. If you need an illustration run, or you're not sure how IUL really works still, give us a call here. Our number will be on the email when you get the response to the webinar here today. But thanks for being on our webinar, and we'll talk to you soon. And Tom, thanks again, bud. Take care.